Hi there, I'm Katie. So today I'm going to introduce what are options. So let's take a look at this screen. We're looking at Tesla stock here. Let's look at the options tab. So you can see that Tesla stock is now trading at a market price of 428.75 USD. Now it's 428.88. Okay, so in this options tab, you can look at the various figures like the date of option expiration, how many days to its expiration, the call options, the puts options, the strike price, the various premiums at different level of the strike price, and then you have the bid ask, the last, and the delta. So first and foremost, let me introduce what is an option. It is a kind of a financial contract. It's a derivative contract and it trades on the options market. So you can look at the exchange here. So there's the SMART, the AMAX, BATS. These are all the different markets exchange. Um, so options are generally quite safe, orderly, and standardized, and most brokers allow you to trade them. So now I'm using interactive brokers. You can also use Hasty Trades or maybe Mumu or even Tiger Brokers, OEMs, etc. Weibo also. So what are options actually? They are kind of financial contract that gives you the right to buy or sell. So, what does it mean? So, example for call options, right? It allows me, if I'm the option holder, to buy the underlying uh, at the end of the expiration of the contract, or anytime if I want to exercise the options contract. And there's also the puts options. So it allows the option holder me to sell the underlying. I also can exercise it anytime. Okay. Now, what is an underlying? So an underlying usually means it could be a stock, like Tesla, or it could be a ETF. So let's take a look. This is an ETF, or famous ETF would be the SPY ETF here. So this is also an ETF with the options uh, call and bid price, call and puts. There are different premiums and there are different strike price. And it could also be a futures contract. Okay. So let's go back to Tesla. So this options contract has a certain price because options gives you the right to buy or sell an underlying at a certain price. This is known as of the strike price. So um there is a relationship between for options trading when we talk about for call options and for put options. Like example, if the strike price, let's say it's $430 and the market price is $431. Okay, so if the strike price is more than the market price, so let's say my for calls, so if my strike price is 432 and my market price is 431, so the strike price is more than the market price, we call it out of the money. And if the strike price is equals to the market price, we call the money. So let's say this is 432.50 and the strike price is 432.50. So this is at the money. And if the strike price is less than the market price, we call it in the money. So let's say my strike price is 430 and now the market price is 431. So the contract for the call options is actually in the money. Now, for puts, it's a different relationship. It's like if the strike price of the put is more than the market price, we call it in the money. So let's say at 435, this is the strike price of the put option, and the market price is now 431, so it's in the money. And the same, if the strike price equals to the market price, is at the money. And if the strike price of the puts options is less than the market price, is considered out of the money. Okay. So these are usually the technical terms that I will use or everybody use. So options by a certain date, um the right the right to buy or sell an underlying at a certain price for either your call or puts by a certain date. So what do you mean by a certain date? Because options have a certain date of expiration. If you take a look, January 3rd is a 7 days expiration. January 10 is 14 days, and so on and so forth. So after that date, the option will stop trading. So options, unlike the stocks, right? It will expire. So let's say January 3rd, 2025, 7 days of date to expiration. On January uh 03 2025, after the trading hours, the options contract will expire. So these are the fundamentals and the basics. Now, what as individual can do, you can buy the call option, which is your right to exercise the option to get the stocks, or you can buy the put options, or you can sell the call options, or you sell the put options. Selling the contracts is the obligation to fulfill to the other party when they uh exercise it. Okay. So these are the basics of options here. I think one more one more information before I end this lesson. So is to tell everyone how to read the, the the title of the options. So example for AG, this is the stock ticker AG, and January 03 2025 is the expiration date of the contract. $5.50 is the strike price, and put or call is a type of option contracts here. So for here, you look at the action, whether are you selling the option or are you buying the option, and the quantity, how many contracts. So usually one contract is 100 shares, and this is the price, or we call it the premium, which when you sell an option, you will get a premium. Okay, and this is the amount that you will get. So for this trade, right, I sold 100 contracts of AG, going to expire on January 3rd, 2025 at a strike price of $5.50. Uh, and it's a put option at a premium of 10 cents, which will give me an amount of $1,000. That's 100 times 10 cents times 100 shares. So that will be your total premium for this. Okay. So I think that's all for introduction to the options. And uh, if you want to hear more lessons on options trading, please don't forget to subscribe to my YouTube channel and also click the like button. So have a great day, everyone.